What's up? All right, so I want to talk the stock market again. Stock market is something I truly love. It's something I really get excited about. I've spent a great deal of time really studying, researching, following, and paying attention to what's really going on. There's a lot of variables that come into play. And the thing is as I've talked to you recently, if you've been staying in tune, and if you haven't, I recommend go back and check out some of my other videos. Be sure you like and subscribe and stay tuned in. But I got some great content breaking down different aspects of the stock market and different aspects of just investing in general, things like that. So be sure you go check those out. But with that being said, I've talked about a lot of different things about what you hear in the media, what you see on social media, what you see in the news, here, there, everywhere. And the reality is everybody's got an opinion. Everybody's got an opinion. And if you're really paying attention to several different platforms, again, several different news platforms, different news sources online, different social media platforms, different sources on social media, everybody's got an opinion, and you know what? It's not consistent either. It's not, which makes things interesting. Everybody's got an opinion, and they're all over the place. There's lots of people talking about that we're in this crisis. Lots of people are talking about the devaluation of the dollar. People are talking about if the dollar devalues, how does that affect the stock market? The currency fluctuates. It does. Now, people don't like to hear that because most of the time that makes them nervous. It gets them uncomfortable. They don't want to know that. They want to think that currency is currency, like a dollar's a dollar. A dollar's a dollar, a peso is a peso, a yen's a yen, a euro's a euro. People don't like the fact to think about the reality is that it does fluctuate. There is inflation and there is deflation, so to speak. It's true. It's a fluctuation. It happens all the time. It happens much more than people really realize because on a daily basis, there is a give and a take here and there. And there's a lot of things that contribute to that. But how does that affect the stock market? Then we got this whole talk about, everybody's talking about the crash, right? First of all, crashes happen. Crashes happen, and we recover. Crashes are driven by the consumer. If you've been paying attention, you've heard me say this before. The stock market is driven by the consumer, and it's driven by the consumer, not by the investor, because the consumer are the ones that make investments on a whim. They do this regularly, daily, monthly, weekly. It happens all the time. A random person, just any given person, will get out there and say, you know what, I'm going to buy in or I'm going to sell. And they do it with little forethought. It's real. Even the ones who think they've given it thought, a lot of times they haven't given it enough. Investors give it a lot of thought. Investors really put their time and their focus. They want to know what's happening. They want to have a plan. Investors buy in for a long haul. They buy in for what I'm going to get in the next quarter, what I'm going to get the next year, what I'm going to get 5 years from now, 10 years from now. They're looking down the road. Now, there are times where they buy into a company and they expected pivots that didn't happen. And they're like, you know what, maybe it's time to rethink. Or maybe they bought into a company because they saw a company was on the cusp of, this groundbreaking idea, product, innovation. They saw this happening. And then after, the thing was supposed to take place in, it's like 6 to 8 months. Like it was in the news. People were talking about it. Everybody knew it was about this new thing. So it's like, okay, maybe this is an opportunity to buy in. But then when you see it was supposed to be a timeline of 6 to 8 months, but they were waiting for this thing or that thing to go through for it to come to fruition, right? And then when that thing doesn't happen, then you're kind of treading water. Especially as a company, a big enough company that's got, shareholders, it's got a board, it's got all these investors that they've got to keep happy. So they've got to start kind of making something happen to make those people who believed in them happy. And that kind of gets into a shaky ground, so to speak, right? Now, this is all speculative and this is all a gray area because ultimately different companies operate differently. Medical companies, technology companies, automotive companies, oil companies, all these different companies operate differently. And even different, one automotive company will operate different from another one, or one technical company will operate different. They all function and operate so differently. Sometimes it's hard to really gauge that. What you need to know, most importantly, is risk management. That's what it comes down to. Now, as I was saying, when you see these companies and they're like, well, I've got these investors and I said this was going to happen in 6 to 8 months, and now we're looking at 10, 12, we're rolling into month 13, 14, it still hasn't happened. What are we going to do differently? Boards have regular meetings. They start gauging what they should do to appease the shareholders. They may have a yearly shareholders meeting where they discuss this with the shareholders. They let them know what's going on. A lot of people are even doing online, digital, virtual shareholders meetings and things like that. Sometimes they do a newsletter for those people who don't want to actually go, right? Berkshire Hathaway is a great one. It's huge, huge, huge company, right? Massive company. And this company has big shareholders meetings. I mean, it lasts, like the whole thing, it's huge. And they have a panel where they discuss things that are happening, right? They let us know as shareholders what's going on and what they feel is in the near future, right? The next quarter, the next year, right? Not all companies do that. But you as a shareholder, you want to know what's going on with your company. You don't want to make decisions on a whim. You want to know that, hey, I did invest based on this new development. That new development didn't happen. Is the company still viable? Is the company still progressing? Is the company at a stalemate? This happened with Tesla. Tesla struggled with different things, different advancements that they were making in the automotive industry, in the EV arena, and how they were competing with other companies, the different things that they were trying to get through legislation, the different things that they were trying to get information they were trying to get out to the public, and some information that because of policies and stipulations was secretive information up for a time period. This makes some people uncomfortable. These are things that you have to consider. You've got to gauge these things and really see. Like I said, it comes down to risk management. If you're going to invest, we call it the ROI, your return on investment. If you're investing X amount of dollars, what are you expecting to get in return? And when are you expecting to get it? Now, if you're just jumping in, most consumers jump in without an ROI expectation. They're basically just saying, hey, I think this is a good opportunity. I'm going to buy in, but I don't really know what I'm expecting. But then they say, well, maybe it's time to get out. Did you get what you thought you were going to get? Are you really that stifled? They don't really know because they didn't have an expectation up front. You've got to learn to gauge these things. You've got to do research. You've got to look at companies. You've got to see what their projections were last year. Did they meet those projections? You got to look what they did. You can go back. It's real easy. There's some great apps out there that you can upload on your phone, many of them free. You upload an app on your phone. I like Stash. Stash is a great one. Stash is real user-friendly. It's real easy. I am no way endorsed by Stash, but like I said, I like it. I'm getting no money or anything by telling you that. I like Stash. I think it's great. I think it's real easy for me to choose that, hey, I'm out and about, and I was thinking about going through a drive-through, but instead of spending $10 on McDonald's, I can drop $10. I could eat something at home and drop that $10 in my stash real quick. It's easy. It's easy for me to drop little bits here and there and think, hey, I made a better choice today. It's very rewarding. Secondly, the cool thing that I really like about Stash is just the idea that you can pull up those charts real easy. You can look at them in monthly increments. You can look at them in yearly. You can go back 5 years. But what you want to do is ultimately, regardless of whether you Stash or you get online, you can look online on your laptop, on your iPad, whatever. You can pull it up on your smartphone. But look it up and you can see what was their development in 5 years. Where were they 5 years ago? Where are they today? Where were they 3 years ago? Where are they today? What did they grow from 5 years ago to 3 years ago, from 3 years ago to 2 years ago, from 2 years ago to 1 year? Gauge those things. Everybody gets on social media and everybody gets on the news and everybody wants to tell you what's going to happen. They don't know. Quote my man Mark Hanna. I don't care if you're Warren Buffett or Jimmy Buffett. Nobody knows. And truthfully, nobody does. For certain. But that's when you want to take this risk management. You want to gauge and manage your risk. You want to really have an idea of what you're going into. If I invest $1,000, what is the likeliness I'm going to be profitable? What is the likeliness I'm going to lose it? I want to take into consideration, like I said, lots of things. What's happening with this company? Okay? What's their potential new developments? How are they competing against other companies that are similar? When we're speaking about similar companies, what kind of company are they? When you're looking at a company like Tesla, you can't just compare Tesla to Ford. You can't. Well, you shouldn't. Now, I do say compare it to Ford and then compare it to some other technology companies, some computer companies, development companies. Because when you compare it to an automotive company, you're going to see how it's trending differently. When you compare it to a technology company, you'll see how it's trending differently. When you compare it to a development company, a new IPO, right? That's always a cool one it's a cool thing to consider. Not everybody does, but I think comparing a company like Tesla to a new IPO is interesting because Tesla's constantly trying to do something new. And some people don't really know how to see it. That's an IPO. It's not an IPO, but it's comparable to an IPO. Because IPOs, people frequently don't know what to expect from them. They don't know where they're going right now. They don't know if this is going to be the company of the future. They don't know if this is going to be, the next big thing. They don't know if it's going to turn around in a year and fall flat on its face. They just don't know. Coinbase was a good example of that. When Coinbase first went public, it was last year. Coinbase went public. Oh man. It's been a year and a half now. Whew. Time on the road is flying by. It's been a year and a half. Coinbase went public. When Coinbase went public, it was a weird thing, right? Because instantly, in that one day, that one first day, it skyrocketed. Everybody wanted a piece. Everybody wanted a piece. Why? Because it was the first publicly traded crypto firm, right? It's a crypto company that was being publicly traded in America. This is a big deal. Absolutely huge. But within 3 days, the stock plummeted. people who bought in first and saw it rising, they sold, took their money and ran. It happens. It's not really the baseline. It's not the norm for this company. It's not the norm for any company. It's what you see with IPOs sometimes. You see they'll come in and they'll either drop or they'll skyrocket. Most of the time, they skyrocket. Sometimes they'll start here and they'll skyrocket and then they'll finish off somewhere here in the middle. And that middle is probably your baseline. Because people buy in and then sell off. Just because they saw, I had a 30% increase, I had a 60% increase, just 70%, I'm out. I want my money and I'm gone. You want to take all these key aspects, right? And really research your company. You want to research your portfolio. You want to make sure that you're gauging and managing that risk to the best of your ability and making sure that what you woke up with, the money that you woke up with this morning, you go to sleep with just a little bit more tonight. It'd be great if you went to sleep with a lot more. But as long as you keep increasing, that's what counts. You are going to lose some in the stock market. There is a fluctuation. You just always want to win way more than you lose. And never go in expecting to lose. Just gauge that loss. Estimate what you think your potential is. And like I said, estimate it based on those variables. What other companies are doing, what this company is doing, what their past is, what their future potential looks like. You want to account for all these things. You can even pull up multiple screens on your computer. Pull up a screen here, here. Have these different companies gauged against them. Then change them, a couple years back. Gauge these variables. You want to really wrap your head around all the potential. And then you want to put your money in. You've worked hard for your money. You don't want to lose your money. You put your time, sweat, tears, energy. You sacrifice time with your family, with your friends, vacation, whatever, so you could work this job, work extra hours, work in your business, grow in your business, and now you got this money in your hand, and you want to invest it so you have potential for the future. Good for you. Do it. Absolutely do it. I am a strong advocate for investing in the stock market, but I'm also a strong advocate for not investing unless you know what you're doing. Don't throw your money away. It is not gambling. This is not poker. You are not counting cards here. This isn't Russian, or this is not a roulette table. This is not a game. This is your money, and you want to remember all the value that it has. You want to remember all the time and effort you put towards earning it. And now you want to put it out there so it can multiply and grow for you, but you want to make sure it's going to come back more valuable than when you put it out there. It's a real thing. Like I said, there's lots in the media about what's going on with the stock market. There's lots going on with what's going on with our economic structure. There's lots going on. They're talking about the effects of other countries. They're talking about the effects of different currencies. They're talking about the effects of potential crypto and digital currencies overtaking the dollar. None of this has anything. Their effect on the stock market is simple. Their effect on the stock market is people's perception. People's perception. Because if you perceive it to change, then you're going to act based on that perceived change. Don't buy into the hype. Gauge your risk. Gauge your risk well. Do the time and the research to make sure that that money you earn, that money you're putting out there, is gonna come back and you ain't gonna lose it. It's your boy. Y'all stay tuned. Y'all, well, for real, I appreciate all y'all. I got love and respect for all y'all that have been following me, been loyal followers, and y'all be sure y'all hit that like button, leave your comments below if there's something else you want me to talk about. But I got a lot more to say about the stock market and about what's going on in our economy and what's going to happen in the coming days, months, future. For today, I'm going to leave you with that. But let's keep moving forward. You know what I'm saying? Like I said, gauge your risk. Risk management is key. All right, hit that subscribe button, ding your bell. Till next time, let's go make that money. It's your boy, get cocky.